After the major sell-off 2 weeks back, it is now safe to say that all those who bought capitalized on a great opportunity as the S&P continues to bounce back this past week, now up by almost 4%, which may leave some of you now questioning whether there still in fact are buying opportunities out there, to which I say there are indeed. 6 of which we're going to go ahead and break down today just after we talk about some of our need-to-know macros. So with that, are you ready? Now let's kick it into gear by talking about arguably the greatest news that we've gotten all year, at least on the macro front for investors, because if we're being honest, the world outside the stock market is almost in total shambles. But that's neither here nor there. This past week, our latest consumer price index report was released, and it depicted that inflation came in year over year at 2.9%, which is down from 3% and the lowest reading yet since 2021. So what exactly does that mean for all of us? Well, Jerome Powell, my friend, you've almost done it. That soft landing deal that you've been talking about is almost legitimate, or at least we're heading in the right direction. And with inflation advancing towards the Federal Reserve's goal of 2%, we're now very well on track to actually seeing that first interest rate cut come September, which would do wonders for all of us. Whether you're just a consumer, maybe you're a business owner, or you're an investor, or all three. You see, in our current economic environment, we've been restricted on multiple fronts, with inflation corroding the value of our dollar, higher interest rates having been pressurizing all of us, but with rate cuts coming and in lower inflation now here, businesses are likely to kick back into gear into spending while consumers get back to consuming, and we could just expect a bull run soon, or at least that's what I'm expecting to happen. Now, during a Federal Reserve rate cut cycle, high yield stocks might become a key focus for investors, and interestingly enough, according to a Morningstar report, dividend paying stocks generally outperform non-dividend paying stocks during periods of declining interest rates, which is often overlooked. Even I was baffled by this report, but this is all because lower interest rates can enhance the appeal of dividend-paying stocks, especially for investors who rely on dividend income as their primary source of investment returns, whether someone's retired or just living off of dividends. Now, another study conducted by the Columbia Threadneedle Investments depicted that historically speaking, companies that increase their dividends tend to perform better off than other stocks when the Federal Reserve actually begins to cut interest rates. So with so many stocks available to us dividend investors, how do we actually go about choosing the best dividend stocks for our portfolios, given we're all in different positions as investors? Well, an easy place that I like to start is actually by using a tool like Moomoo's high dividend list. Now, that's all you have to do is set a dividend yield range, then choose stocks with a share price over $1, and depending on what you're looking for in terms of a market capitalization, enter the range there too. I usually target market caps of at least over 10 billion. Now, from there, you're going to get a list sorted by dividend yield. Now, you should always check to see if the stocks that you're looking into are actually growing their dividends, because that's crucial for long-term investors, but also be sure to check out when the dividends are actually paid out so you can buy the stock before their ex-dividend date. Now, Moomoo also offers a very unique one-click covered call strategy to earn extra income if that's your thing and you're into covered calls. But most importantly for me is just knowing that Moomoo has zero commission trading, and right now using my link, you can actually get 15 free shares, enjoy an 8.1 APY on cash sweeps, and earn an extra $300 bonus for rolling over your position, though terms and conditions always apply. Now, these benefits all stack up, but I personally want to thank Moomoo for sponsoring today's video and offering up a brand new suite of tools geared towards us dividend investors, which actually allowed me to compile today's list of dividend stock picks. So let's get to them now with Medtronic, ticker symbol MDT, up first. As a medtech leader manufacturing anything from medical instruments for surgeries to analyzers and scanners, right down to pacemakers and glucose monitors for diabetes. Now, truly a company that's producing just about everything that we need to live longer, healthier lives that has quite honestly had its butt kicked over the last few years from our economic environment that called for extreme cost-cutting measures on hospitals, healthcare facilities, and the alike. Meaning Medtronic's bottom line was impacted, to which we're going to see that Medtronic has been down by over 30% over the last few years, trading for just $81 per share. But zoom in here a little bit to see the climb over the last year here as we get closer and closer to interest rate cuts. And zoom back out with me over to the 10-year here to see over 62% worth of share price appreciation. But that's not all. We have bullishness from the analysts predicting a share price hitting $96 per share. That would be 17% worth of upside from here, while hedge funds have certainly been loading up with over 3 million shares purchased last quarter. And until the rebound, well, we're talking about one heck of a safe dividend coming in at a 3.43% dividend yield. That's been shelled out for the last 46 years worth of a track record there, while growing on average by 12% year over year for the last 20 years. But if you're looking for more of a growth-oriented opportunity, I'm actually going to go ahead and head in a bit of a radical direction that some of you may find to be a bit more risky with Salesforce, ticker symbol CRM, which, if you're not familiar with it, is directly engaged in the development of cloud-based enterprise software for customer relationship management. Essentially, vital software for all of those who work in sales. But I'm actually throwing this one into today's mix because I'm thinking ahead to interest rate cuts, and I'm only expecting that small, medium, and large-scale businesses are going to come back around to investing heavily into their businesses and ramping up their CRMs, meaning this company is going to be a direct beneficiary. And right now would be an ideal time to take a look into Salesforce, given their share price is at $253 per share, down from over $300 per share months back. This discount is likely not going to last long, as analysts are very bullish on Salesforce, forecasting a share price to hit $287 per share. It's about 12% worth of upside from here. Now, there's also been some relatively recent insider trading activity going on, but the bigger focus for me is, at least when it comes down to the hedge funds, with over 1.7 million shares purchased last quarter. And until Salesforce is back up in full force, there's a dividend yield to take advantage of here. While small, it is certainly mighty, coming in at 0.63%. Though I recognize most of us dividend investors are really going to go after more stability and reliability with bigger yields. So let's talk about Home Depot, ticker symbol HD, which is, I'm sure you know, one of the largest home improvement retailers in the entire world. Now, when it comes to this particular investment, I am all in on Home Depot, just considering the fact that I know interest rate cuts are coming, whether in September or later. But when they do come down, the housing market and any building projects are going to be the biggest beneficiaries. So Home Depot providing all the tools is a great way to get your capital working for you in this particular space. Regardless, right now, Home Depot remains up nominally on the year, but it's off its peak of roughly $392 per share, trading for $355 per share. Yet be long on this investment, because you could see here, we get over 408% worth of appreciation over the last decade. Now, analysts, as of right now, foresee over 10% worth of upside, coming back up to $391.57 per share. Yet until then, you're going to be able to collect on a dividend coming in at a 2.53% yield that has been growing by a whopping 19% year over year, while maintaining a 36-year dividend streak. Now, investors, 3 down, 3 more to go. But before we run through them, I want to call on you right now to help me out by subscribing to the channel. You see, as this channel grows, I'm actually going to be able to put more focus on it, meaning my ultimate goal is going to be a video a day. That means more stock ideas, economic insights, and more informative masters of the market guests for all of you. But it takes a village. That's the truth, and that includes you. And while you're at it, I want you to go ahead and tap on that thumbs up button. That just lets me know that you're actually getting value from videos like these, so I can keep producing them if, of course, you are enjoying them. With that, let's get back to it with Canadian National Rail, ticker symbol CNI, which is one of Canada's largest freight line operators, working rail all the way down to the south of the United States. But my thesis here just comes down to insights when it comes to logistics companies altogether. All of them have been hindered by higher interest rates and inflation, and as both metrics trickle down, the cost to move freight or commodities just becomes cheaper, and companies like Canadian National Rail are going to benefit. So as it's currently trading for $111 per share, which is down by almost 11% on the year, it is likely a great time to look into this company, especially with that PE ratio at 17.8. And moreover, zoom out to see over 93% worth of share price appreciation over the last decade, and even stronger bullish indicators here when it comes to the insiders that have been buying more recently. $500,000 purchase by a director not too long ago, all while hedge funds have been loading up on Canadian National Rail as well. Now, on top of all of that, analysts are in fact very bullish, coming in with 19.7% worth of upside from here, hitting $133.09 per share. And until then, you get a solid dividend yield coming in at 2.21%. That has been growing on average by 16% year over year, all while maintaining its 27-year dividend track record. Now, there's further stability with an iconic name like McDonald's, ticker symbol MCD, which has been truly bleeding out all year long, whether it's geopolitical issues or just on an economical front with their menu prices spiking too high for consumers. But I remain long on McDonald's for 2 reasons. 1, I don't really ever foresee the Big Mac and fries going out of style. And 2, I just think that their real estate empire is ever expanding. So this stock right now is down by 7.4% on the year, trading for $271 per share. Lower P for McDonald's coming in at 21.4. If we click into the 10-year, for those Big Macs and fries, we get over 272% worth of share price appreciation, while analysts remain bullish with an additional 9.5% worth of upside expected from here. That brings us up to $297.82 per share. But until then, you're going to get a savory taste of a McDividend hitting your brokerage account with a dividend yield coming in at 2.46%. That continues to grow at a pretty fast rate of 15% year over year, and it's been on a dividend streak now for the last 47 years. However, I now want to share the one opportunity that I personally am really bullish on and have been loading up on for months now. It's been Alphabet, ticker symbol GOOGL. And while many of you may be crying about the lower dividend yield, I'm going to be laughing the entire way to the bank on a total return basis. Now, Google is in fact the world's largest search engine, but it also owns YouTube. That's the world's second largest search engine. And most importantly is just thinking about the future here when it comes to interest rate cuts and companies pouring money back into advertising, which they're likely to head to Google for Google Ads, and that's going to drive Google's revenue once again. And for those of you wondering, I'm not really concerned a whole lot about all the antitrust concerns out there, and it doesn't scare me in the slightest. I think it's all temporary noise. So just consider this. Right now, Google's in the red zone, down by almost 7% over the last few months, trading for $161 per share, yet still up overall in the year by 15% and up over the last decade by 437%. Well, I am all in here on Google. Now, analysts are bullish with 26% worth of upside forecasted. That would bring us up to $204.50. But the only thing better than that is the hedge funds that have actually just been buying hand over fist. Now, until Google is actually back on the mend, a small but mighty dividend is coming in at 0.5%. But remember, it's all about the total return with Google. And there you have them, the dividend stocks that I am most bullish on moving into this week. Comment down below with your thoughts on these stocks, if you own these stocks, planning on buying them, or actually if you have better dividend stocks in mind. Be sure to catch more insights right here, but before you click away, be sure you're subscribed to never miss a single video.